Hello everyone, this is an explanation of the answers to your practice problems on leases. So we're going to start with exercise number 1. First thing to do is consider what it is, and because it fits the criteria, it is a finance lease. Ownership transfers at the end with a bargain purchase option, so that makes it qualify as a finance lease. So whether it was a finance or an operating, we still need to do the present value to know how to record it. Initially, the amount we should record. So I've shown you the formula here. Present value, we use the interest rate given, number of periods, 34,000 is the payment, $10,000 extra purchase option is in the future value line, and then type, because this is at the beginning of the period, is 1. That tells it to use the beginning of the period for a lease. That gives us 242. You can also see down here I did it in 2 steps by doing the payments in one and then the present value of just the 10,000 separate and then adding them together. So this is just a longer way to do it, just in case that makes more sense. So once we have that amount, we can record our lease. ELF records it as an asset and a liability. Santa, this is a sales type lease, records it as a lease receivable, and sales mentions that the cost to Santa was $165. That's what they're carrying it for in inventory. So you also record inventory and cost of goods sold. The first payment is made immediately on January 1st. So we debit the liability and credit cash, or debit cash and credit the receivable, depending on which side you're on. No interest because no time has gone by. First payment is going to be entirely principal because no time has elapsed. Okay. After a year, though, we have interest. Record interest on the amount of the lease liability minus the first payment is going to give us your interest expense for the period, 9% again. At mirror image for the less or, they record the interest receivable and interest revenue. So interest expense for the lessee, interest revenue, receivable payable. Then because it is a finance lease, the lessee records depreciation. Lessor has given up control, so the control goes here to ELF and they record depreciation using the 12-year useful life because of the ownership transfer rather than the 10-year lease term. So remember, it is the shorter of the two unless there is a ownership transfer, and then you use the useful life, just like if you had bought it. All right. At the beginning of the new year, you make your payment, credit cash, you debit this payable you recorded earlier, and reduce the lease liability for the difference. Same thing happens on the Santa side. We credit the lease receivable and interest receivable, just like we recorded earlier. Then one more year, you do interest again, interest payable, and depreciation again, just so you can see that. Notice that the interest is going down because you paid more off of the lease liability with this payment here. So that's problem number 1. Problem 2, or exercise 2, is an operating lease. It does not fit the criteria for a finance lease. So it has payments like this: 60,000, 63, 66, 69, 72. We are going to use the net present value formula here that gives us a way to figure it out with unequal payments. Present value we used earlier is only for equal payments. These are different. So we take the net present value, as explained in an earlier podcast, of the remaining payments plus the 60,000, we get 272. That is a debit to the asset and credit to the liability. On the Rudolph side, Prancer does not make it. The seller or the lessor does not record an operating lease at the inception. Okay, there's no entry there. Now, when we record lease expense, it is for the amount. We added up all of the payments, got $330,000 divided by 5. So the average or the straight line amount of rent revenue or lease expense is 66. So on Rudolph's side, we record lease expense, credit to cash. The difference goes to the lease liability or the leased asset, whichever you prefer. All right. The Prancer makes the journal entry just the opposite, recording revenue and the cash, with the difference going to an unearned revenue account most likely. Okay. After the second payment, notice that the payment now is 63, right? Lease expense is the same. Okay, the difference is lower than it was before. Then the tricky part, redoing the net present value using the payments in the future, 3 payments, then adding the 63,000 gets us the 234. The difference between what our asset and liability was before and it is now is 38,716. I've rounded everything to the nearest dollar, and we debit the liability and credit the asset. In the third payment, the cash and the lease expense is the same. I did not ask for subsequent payments from Prancer. And then we do the same thing, net present value for the last 2 payments plus the 66. And we get a difference of 45. We're reducing the lease liability and debiting the liability and crediting the asset for that amount. Notice the formula of how we do net present value and then the difference. And the last problem or exercise is actually exercise 3, but it's very similar to exercise 1 in that it is a finance lease. Okay, we figure out the present value just like we did before, 9%, 10 periods. Where did my... There it is, exercise 3, sorry. Okay, didn't go down far enough there. Present value 282 this time because the interest rate is 8.5. Okay, 8 payments, 43,112 with a residual of 35,000. Guaranteed residual treated as a payment. So this is how it would look on the lessee side. First payment, leased asset, leased liability. On the lessor side, we debit the lease receivable and credit machinery for the same amount. There is no profit on this. This is a direct financing type lease. And so we record the cash just like we did before. Interest, revenue, interest receivable. No depreciation on this side, only on this side. This time we use the lease term because instead of a transfer of ownership, the assumption is that we will give back the asset at the end of the lease term. So we're only going to depreciate it over the 8 years, not the useful life. Okay, these journal entries look very similar to what we did in exercise 1, except for, of course, using the correct percentages and multiplying by the new values. So that's how you would do that to calculate leases and make the journal entries to figure that all out.